Hi everyone. So welcome to a brand new week and welcome to our live stream session today as we prepare towards the ICA August 2022 examination. It's a new week and technically we have about 4 weeks to go for the August 2022 examination. I think Friday is going to be 31st of July and 31st of June. And so in July we have 4 more weeks to go and that will be all for us for the August 2022 examination. I believe that you have been studying, you've been working hard, and you've been preparing pretty well as we gear towards the examination. Now, in case you've not been serious, like I used to say all the time, you have to really put in the work. You have to really start studying and start working hard so that you can put yourself in the position to be able to not just go into the exam hall and write the exams, but most importantly, pass the exam because the ICA exam is really not difficult. If you work hard, you do the right thing that has to be done, you put in the work, you put in the effort, and you study in a manner that you are expected to study, definitely you can make it happen. So welcome to a brand new week as we continue with our discussion, and today we are looking at a cash flow statement masterclass. I mean, this is something that you guys have requested that we do in the on the live stream. So today we're looking at IAS 7, the preparation of the cash flow statement. This is one of the fundamental financial statements that the examiner could access in financial reporting, or profit or loss and statements of financial position. Then for those of you doing corporate reporting, in corporate reporting there is consolidated cash flow. It means we are doing group situation there in corporate reporting. However, the fundamental things that we're going to be discussing today in the IAS 7 dealing with the cash flow statement for corporate financial reporting will be crucial to help you to be able to then do the consolidated cash flow statement. So welcome to the stream today. I see some of you guys joining. Welcome. Give us a thumbs up on the video when you join. It helps us a lot. But most importantly, put in the comment section, put in the chat any questions you have for me, something you would want me to share my thoughts on as we begin this new week and continue with our discussion for the August 2022 examination. Now, remember that you can download our mobile application, the Nhyira Premium mobile application on the Google Play Store, the App Store, and get access to some exclusive content, some lecture videos, some documents or posts that will help you to really prepare well for your examination as well. So, cash flow statements. Cash flow statements, really really interesting topic that we're going to be discussing today. Remember, like I say always as well, our discussion is going to be coming in from my notebook on financial reporting and corporate reporting. This is our notebook that we released this year, and we're going to be bringing in our discussion technically from this place. So everything I'm going to be discussing with you actually today will be coming in uh, from this book, and we are going to be having a discussion there. I see some of you guys jumping on. You are welcome. Give us a thumbs up on the video, comment in the chat box, let me hear, or the comments box, let me hear from you. Where are you watching from? Any questions for me? I will really be excited to hear from you guys. So let's see. Let me pull up my screen and let's get excited about the day's discussion. I see some charts coming in. Let's see if I can look at them. Uh, Some Israel said, "Good evening, sir. Good evening, Israel. I hope you're doing well." Then we have Joseph. Okay, you type your name. Okay, to represent. You are welcome, Joseph. G. Clark said, "Good evening. Good day. Joining from Liberia. Thank you for joining us on the stream today." Abasi Said said, "We are here and ready." Awesome, Abasi. Thanks for joining us on the stream today. Saranji said, "Hello, Inshira from UK. Your videos are inspirational." Thank you very much, uh, Saranji, for joining us on the live stream and also finding inspiration in our video. It's really a privilege for me. Timothy said, "Good evening, sir. Please, is scrap?" That's not how you spell scrap, Timothy. You've brought your Saito things on the live stream. That's not how you spell scrap. Please, is scrap value the same as recoverable amount. That is fair value. Nope, 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 nope. That's a different ball game altogether. Okay, Timothy. Scrap value is the estimated value at which an asset will be sold at the end of at the end of its economic useful life. So when an entity buys an asset, they would determine that, okay, this asset we're going to use it for 10 years. And after 10 years, we expect that we would sell the asset for, say, $2,000. So the value at which they expect to sell the asset is what we refer to as the scrap value. Okay. However, recoverable amount is if we want to sell the asset today, right now, how much can we sell it for? How much will we get? And that is where fair value less cost to sell comes in. So scrap value is the estimated value at which the asset will be sold at the end of its economic useful life. Okay, that is scrap value. However, recoverable amount is if the asset is being sold today, how much will we get from it? That is the recoverable amount. Let me know if the difference is clear for you, Timothy. Let me know if that it's clear for you. Iwa Solomon said, "Good evening. Good evening, Solomon. Thanks for joining us." Sharifa Ben Poma said, "Hi, Shira. How are you?" Hi, Sharifa. I'm flourishing. I hope you're also doing well. And then we have Ayinde said, Ola Ayinde from Lagos, Nigeria. Thank you for joining us on the stream today. Osman Abolaji said, Shakurat from Nigeria. Thank you, Osman, for joining us as well on the stream today. So let's get excited. Let me bring my writing part up and then let's uh, go into our discussion today. And that is going to be IAS, 7 cash flow statement. It's one of the OGs, one of the oldest accounting standards that you can actually find the cash flow statements. Cash flow statements. Now, the idea about the cash flow statement came because of the fact that investors then did not understand the performance of the organization and how companies are expected to be run. Why? Because the statement of profit or loss may indicate a profit for, say, whatever, let's say $10,000. So the statement of profit or loss indicated that there is a profit of $10,000. But then you go to the statement of financial position, and the cash and cash equivalent there, meaning, your bank deposit, cash in hand, and all that, cash and cash equivalent there, it's, let's say, negative, or maybe let's just be a little bit fair, 1,500. So for the year, the entity made a profit of $10,000. However, on the face of statement of financial position, the money they actually have available is just $1,500. So investors began to think that what exactly is going on here? Is management trying to embezzle our funds? Is management actually taking advantage of our organization, our company? What exactly is going on? Because how can you report a profit of $10,000, but you have just cash and cash equivalent of $1,500? What they forget, or what they forgot, was that profit, okay, it's not equal to cash and cash equivalent. Okay, profit is not equal to cash and cash equivalent. The fact that you've made X amount of profit does not actually mean that money is sitting down waiting for you. So investors, began ranting. So then the International Accounting Standard Board now decided that, hey, let's bring some discrepancy. Let's try to reconcile the statement of profit or loss with a statement of financial position. Let's try to find the reason why a company will make a profit of $10,000, but on the face of the statement of financial position, they will have only $1,500. So the process of reconciling the statement of profit or loss to the cash and cash equivalent in the statement of financial position is what refers to as the cash flow statement. Does that make sense? That is the idea. That is the reason for the cash flow statement. So when we are preparing the cash flow statement, we are trying to reconcile the profit in there, or the profit or loss in the statement of profit or loss account, with the cash and cash equivalent balance sitting on the face of the statement of financial position. We want to find out, why is it that there is a profit of 10,000, but we have only 1,500 there? Now, there could be various reasons why these discrepancies will be there. For instance, it could be that the entity has purchased more inventories. Okay, so there is increase in inventories. That is why we have less cash available. Or it could be that there is increase in debtors. Okay, increase in trade receivables, meaning that our debtors are not paying us. So if they are not paying us, even though we are selling, there is revenue going in, there is no cash coming in. That could be a reason. Or maybe it could mean that during the year we acquired some property, plant, and equipment. So acquisition of property, plant, and equipment. In that case, then the cash we have available will definitely reduce. Or maybe during the year, we actually acquire some financial instrument as an organization. Or maybe during the year we paid some dividends as an organization or as an entity. Or maybe during the year we repaid some loan notes during the year as an organization. So there are various reasons why you will make a profit of, say, $10,000, but you have only 1,500 available on your statement of financial position. So it is not that, oh, management, quote unquote, has embezzled the funds or is actually spending our money. It is that probably these things are the reasons. And the movement in these items are not captured in any financial statement. You don't see these movements in the statement of profit or loss. You don't see these movements in the statement of changes in equity. You don't see these movements in the statement of financial position. So the only way, or the only place that we can bring in these movements so we can reconcile the balances, will be the cash flow statement. It is for this reason why the cash flow statement came to being. Any questions, please? That is our introduction to the cash flow statement. So you need to understand why we are preparing this. And once you know that it is about reconciling our profit or loss with our cash and cash equivalent in the statement of financial position, it becomes pretty easier for you to be able to understand exactly what is going on. All right. I see some chats coming in. A follow-up question from Timothy. Let me see if I can address that quickly, then we proceed. Hannah Orlando Hakim said, "Hi Nhyira, long time. I've been here live stream always. Maybe you've been away. Hakim, I hope you're doing well." Alberta Ekubia said, "Good evening. Good evening, Alberta Ekubia. Thanks for joining us." Timothy said, "Thanks, sir. So when determining the recoverable amount, do we add it to value in use discounting figure at the end?" No, 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 no. Relax. You see, what you're asking, it's like you're messing up everything that you are dealing with. I don't know if your question centers around IAS 36 impairment of assets. Because if you are dealing with impairment of assets and you're looking at recoverable, you're dealing with recoverable amount, then two things must be in your head. And the statement you are making tells me that you don't understand how we arrive at recoverable amount, because the recoverable amount is the higher of value in use and then the net realizable value, or fair value less cost to sell. These are two different things. So there is no way you add value in use to recoverable amounts. No, 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 no. You can't add value in use to recoverable amount. The recoverable amount is the higher of these two guys. That is the idea about impairment. That's how you arrive at the recoverable amount. It is the value in use that you have to discount into present terms. That's what you have to discount into present terms. So you compare the two. The one that will be higher becomes your recoverable amount. So that's the issue there. Okay. Any other questions, please? I see some of you guys joining. You are welcome. Give us a thumbs up on the video, helps us a lot. And also, let me hear from you where you are watching us from and any questions you have for me. So, now that we've understood the introduction to the story and all that, let's get excited about some KG2 definitions in that case. So, I'm going to be coming in from my book on financial reporting. So for those of you who are here who have my book on financial reporting, if you have a corporate reporting book also, this is there. You just open to the chapter. I think that will be in the volume 2. Cash flow is in volume 2, and then you can follow me in that case. And if you have the financial reporting book, it is on page 430, and then you can follow me there as we look at some key definitions right here. So let's go. Now, for us to be able to deal with the issues relating to the cash flow statement, then we need to look at some key definitions quickly. So what is cash? Cash comprises cash in hand and cash and some bank deposits. That's cash. When we say cash equivalents, these are short-term, highly liquid investments. Listen carefully. Now remember, the examiner can ask you to define these things. Theory area, there is always going to be written parts in your corporate reporting exams or your financial reporting exams. So the examiner may ask you to define these things. So it is important for you to understand them and then be able to write out your English. So when we say cash equivalent, we mean these are short-term, highly liquid investments that are short-term, highly liquid investments that are readily convertible to known amounts of cash. They are readily convertible to known amounts of cash. Highly liquid. Highly liquid. So maybe it could be treasury bill. If it is highly liquid, you could convert it into cash in a short possible time. That could be considered as a cash equivalent. Or it could be shares that you have bought and you expect to sell it in the shortest possible time, or it's a share that trades well on the market and hence you can sell it as soon as possible. It could be a financial instrument, a financial asset, but it will be a cash and cash equivalent. So any short-term investment that can be converted into cash in the shortest possible time can be considered as cash equivalent. Then when we say cash flows, we mean the cash inflows and then the cash outflows. Now, if you remember my explanation that I did to you here, when inventory is increasing, it's an outflow. It means we are buying more inventories. Okay. But then when inventory is reducing, it means we are selling the inventory. So reduction in an inventory, it's an inflow. Does that make sense? So when your inventories are going up, you are buying more inventories, that is outflow. But when your inventories are coming down, you are selling more inventories, that is an inflow. The same thing happens to your trade receivables. When your trade receivables is going up, it means that the people who owe you, they aren't paying you. So you're actually losing money. But then if there is a reduction in the trade receivables, it means they are paying you. So money is coming into their business. All right. Then acquisition of assets. That is an outflow. You are going to be paying for the acquisition of the asset. But then if you dispose of the asset, the proceeds from the disposal of the assets, it's an inflow coming in as well. Acquisition of financial instruments, it's an outflow. You're going to pay money. But then when you dispose of those financial instruments, that is an inflow to you at the end of the day. Payment of dividend. When the entity pays dividend, that is an outflow. Money is going out of the business. However, when the entity receives dividend during the year, that is an inflow to us. We have to consider that. Repayment of loan notes, it's an outflow. You owe someone and you are paying the person the amount you owe him or her. Payment is an outflow, but then if you issue loan notes during the year, that's an inflow. Okay, so issue of loan notes becomes an inflow. All right, for us. So that is the meaning of cash flows. In this discussion, we are going to be looking at both inflows and then outflows during the year under review. But then our cash flows is going to be prepared, and we're going to categorize all the activities that the entity undertakes into three. So we're going to be coming from three main activities. So we're going to be preparing our cash flow statement from three main activity. So we're going to be having cash flow from operating activity. We're going to having cash flow from investing activities. Then we're going to be having cash flow from financing activities. Now, I want you to stay with me very carefully here as I try to walk you through this. Then we can begin to, you know, get excited about the discussion for the day. I see some of you guys joining. You are welcome. Give us a thumbs up on the video. Comment in the comment section or the chat box. Any questions you have for me, something you would want me to share my thought on, put it in the chat for me. I would really love to hear from you. So, cash flow from financing activities, cash flow from investing activities, cash flow from operating activities. Now, when we say cash flow from operating activities, what do we mean? It means we are looking at the core activities of the organization. So we are looking at the various cash flows from the core activities of the organization, from the core operations of the organization, what the entity exists to do. That is what we are interested in. What the entity exists to do, that is what we are interested in. All right. That is what you need to understand in relation to the core activities there. That's what you need to understand in relation to the core activities. But then when we talk about core activities, then what are we talking about? A number of issues we are talking about. Under the core activities, we are going to be dealing with issues relating to your current assets. So we're going to look at movements in the current assets. Okay. We're going to be looking at issues relating to current liabilities. So we're going to look at movements in our current liabilities. We're going to be dealing with other issues, various other adjustments that has to be made to the profit or loss account. And we're going to get ourselves into some of these adjustments in a moment. So don't worry. So in the operating activities, we are interested in the core activities of the organization, in the core operations of the organization. And in that operating activities, we may be doing adjustments for current assets, we may be doing adjustments for current liabilities, we may be doing adjustments to the profits of the entity. But you see, one thing you need to understand is that the operating activities in the cash flow statement can be arrived at using two basic methods. We have what we call the direct method and the indirect method. All right. So when we are preparing the cash flow statement and we are looking at the operating activities and we want to arrive at the operating activities, there are two methods that are applicable. We're going to be looking at the direct method and then also the indirect method. Please note that you are going to be using the indirect method in the exam hall, where we begin with the profit before tax for the year. Okay. where we begin with profit before tax. So usually that is going to be our default method for preparation of the cash flow statement. That's going to be our default method, the indirect method. And we're going to get into that in a moment. But then the direct method is where you are really going to prepare the cash flow from operating activities by taking into consideration the actual things that the entity undertakes during the year. Okay, by taking into consideration the actual activities that the entity undertakes during the year. And that is where we're going to be dealing with the direct, or what we call the direct method, in the preparation of the cash flow from operating activities. So here, what you're going to be looking at is, okay, how much did you pay to your employees? Okay, so you're going to be bringing into consideration payments to employees. All right, payment to employees. You're going to be bringing into consideration payments to your suppliers during the year. Okay, you're going to be bringing into the picture also any interest that you have paid during the year. Okay, then any tax that has been paid during the year. In that case, so you are looking at really your actual activities. Okay, how much did you receive from your customers? Okay, so receipts from the customers. How much money did we receive from our customers? So with the direct method, it's a little bit funny because like you are going back to the normal KG2 situation, and then you work yourself up in that case. And I'm going to illustrate this to you in a moment so you understand the difference. But then in the indirect method, which is what you are going to be doing in the exam hall, you're going to be starting your journey with profit before tax. So you're going to start your journey with profit before tax. Then you're going to adjust that profit before tax. The way you adjust that profit before tax is to start with non-cash items. For instance, remember we are preparing cash flow statement, and we said we deal with cash inflows and cash outflows. We deal with cash inflows and cash outflows. So anything like depreciation, it's a non-cash item. So depreciation, amortization, these are non-cash item. Impairment, these are non-cash item. So all these amounts are expenses that were deducted in arriving at a profit before tax figure. So what do? We add it back. Do you understand it? We add it back because depreciation is an expenses, amortization is an expenses, impairment loss is an expenses. However, these are non-cash items. So when we are preparing our cash flow and we are doing using the indirect method, which is our default method, we must make adjustments for that. Then sometimes during the year, the entity might have disposed of some assets. And so when it disposed of some assets, it made either profit or loss on the disposal of assets. Now, the company is not in the business of buying and selling assets. Remember, we said the operating activities are the core things we do. So it means that when we are looking at our adjustment to the profit or loss, any profit or loss on the disposal of an asset affected that figure, which is the profit before tax figure. So what do we have to do? We need to adjust that. We need to remove the effect of the disposal. Now, if it was profit, that means it was added in the P&L account. So when we come to the cash flow statement, we'll come and subtract it. So if they made a profit, we will come and deduct it because it was added. If they made a loss, it means it was deducted. So we'll come and what? Add it here. That's why I'm putting the profit into brackets. That's why I'm putting the profit in brackets. All right. Then, so that is the effect of that as well. Then maybe during the year, we received grants from the government. Stay with me carefully. Stay with me carefully here because we are starting to dive a little bit deeper where your brain has to work very well to be able to understand what we are doing. Remember, as per IAS 2 government grants, the default method for IAS 20 government grants, the default method is that the grant is recognized as a deferred income, okay, and amortized over the economic useful life. What does that mean? It means that if during the year the entity received any grants, then in the P&L accounts, they would have charged the grant for that year and added it and arriving at the profit before tax figure. So what do? We subtract it. That annual allocation that was sent to P&L that is supposed to be sent to the P&L, we will deduct it. Now, the total grants that was actually received during the year will go to investing activities. But then the annual charge will be taken to P&L and we have to adjust it in the P&L accounts. How we are getting the idea here? Then remember, we are picking profit before tax, meaning interest had been deducted already. So we're going to bring in the interest charge for the year and then deduct it. Why are we deducting the interest charge? Because remember, we are dealing with cash flow statements. Stay with me carefully. We are dealing with cash flow statements. And the interest charge for the year may not be the same as the interest paid for the year. Stay with me carefully. The interest charge for the year may not be the same as the interest paid for the year, especially if in the statement of financial position we have outstanding interest. That means we have to do workings for interest paid for the year. So interest is a liability, so it has a credit balance. So we bring in the opening balance. Remember, you will be given two sets of financial position last year and this year, and you will be using the current year profit or loss account. So be careful on that. So you bring the opening balance on your interest. You close this account up to bring your closing balance here. Then the interest charge for the year, which is what you are deducting here, is the charge for the year. So you're going to bring it here. So charge to profit or loss. Then you balance this account. Always, when you balance this account, the credit side will be greater than the debit side. So the balancing figure will be on the debit side as the interest paid. As the interest paid. I hope you are following. If there are any questions, you put it in the chat or the comment section for me to seek clarity on everything or anything. But then, if it happens that in the question, in the statement of financial position under current liabilities, we don't have interest owings or interest outstanding, then what is going to happen is that your interest charge for the year will be the same as the interest paid. I hope you are getting the idea. The interest charge for the year will be the same as the interest paid. The interest charge for the year will be the same as the interest paid. But then, if in the statement of financial position we happen to have interest owings, interest outstanding under current liabilities, then we have to prepare the interest expense account to determine how much interest that was actually paid for the year under review. Okay, so that must also be adjusted for. That must also be adjusted for. So any depreciation, amortization, impairment loss, any profit or loss on the disposal of assets must be adjusted for. Grants that was charged for the year in the P&L account must be adjusted for. Interest charge in the P&L account must also be adjusted for. Then we can get a cash flow, coming in from operations in that case. Now, if we are dealing with consolidated cash flows, then we could bring in share of associates profit or loss here and adjust for it as well if you are dealing with consolidated cash flow for the corporate reporting students. But then we're going to now bring in movement in working capital. And I told you about that already here, if you remember, the movement in working capital If there is increase in inventory, it means money is going out of the business, and so you must adjust that in the financial statement. So increase is out, decrease is in. So increase slash decrease in inventory. An increase means money is going out, a decrease means money is coming in. The same thing will happen to trade receivables. The same thing. Increase means you are losing money, decrease means the debtors are paying you how much they owe you. And so we bring in there in that particular case. Then when it comes to trade payables, increase in trade payables is an inflow, decrease in trade payables is an outflow. Why is that? Because when your liability, current liability is reducing, it means you are paying the debt. Does it make sense? When your liability is reducing, it means you are paying it. If your liability is increasing, that means you are not paying it. Okay, so increase in trade payables is an inflow, but then decrease in trade payable is an outflow, meaning money is what? Going out of the business. We are losing money as an organization. So the idea I want you to have with this particular one here is that you deal with current assets. Increase in current assets is an outflow. Decrease in current assets is an inflow. But if you come to the current liabilities, increase in current liability is an inflow. Decrease in current liabilities is an outflow. Does it make sense? So that is the thing that you need to understand relating to that. I'm seeing some questions coming in. Let's see if I can look at them since they relate to exactly what I'm saying here. Sharifa said, Insurer, please, I want tutorials on employee benefits, business valuation, and share-based payment. We've not had any really resounding demand on some of these things, but you can get access to these videos on our main courses on our online portal. But for now, we don't have any videos on these things available on YouTube because we've not received any demand for them. But all these things are covered on our online lecture videos on our website. Which Iberi said, just as direct method is used in recording actual activities of the year, what does indirect method records? Okay, I think I've answered that already. Iberi, let me know if that makes sense for you. The indirect method, we are starting with a profit before tax from the P&L account so that we can work our way to adjust that figure to mean the real cash flows of the company, then we know exactly what we are expected to do. So, Iberi, let me know if your question has been answered. Then Samuel Sapon said, please, can you go over the treatment of government grants again, sir? Okay, so what we said is that per IAS 20 government grants, the default treatment for government grants is that it should be recognized as a deferred income. So let's say, for instance, an entity bought an asset. Okay, let's say we bought an asset for whatever, let's say $10 million. Then the government of Ghana said, oh, beautiful, you bought an asset of $10 million. You're going to create job. For that reason, I'm giving you a grant of $2 million. Okay, so I mean, the economic useful life of our asset is 10 years. Now, if that is the case, the grant is going to be amortized over the 10-year period. So it means that the double entry for the asset we've bought is we'll debit PPE, property, plant, and equipment, with a $10 million, and then maybe credit cash if we've paid for it, or credit payables if it is outstanding for the period under review. So that is general entry for the cost of the asset. Initial recognition. Remember also that this is initial recognition. Then the grants that we received, we will debit cash if the government has given us the money actually, or we will debit receivables if it is a promise and we expect to receive it. Then we can then credit government grants as a deferred income. We'll credit deferred income in the name of government grants. I'm not supposed to be using XX since I introduced some figures, and that's $2 million. $2 million. Sounds good. So this is your initial recognition. Now, on subsequent measurement, what we are saying is that you're going to depreciate the assets. So you charge depreciation on the assets, and that is going to be the cost 10 million over 10 years, and that's going to be $1 million, and that is going to be debited to profit or loss and credited to PPE. PPE. So this depreciation of $1 million is what we are adjusting for under the operating activities here as depreciation. That's what we are adding back because depreciation is a non-cash item. Then the grants will have to be amortized over the useful life of the asset. So the annual charge for the grants, or what we say charge to P&L. So the grants charge to the P&L will be the $2 million over 10 years, and that's going to be $0.2 million. So what is the journal entry for that $0.2 million? You debit the deferred grant account. Remember, initially you credited it with a 0.2, and then you now credit your P&L account, profit or loss, 0.2. So this 0.2, which you credited to the P&L account, increased your profit before tax figure. So now we have to come and what? Deduct it. Now we have to come and deduct it. I hope you are getting the idea. That is the issue relating to that. Samuel Sapon, let me know if that explanation helped you to understand the grant treatment. Then Joe Thomas said, please, can you go over the increase and decrease in current assets and current liabilities concerning the inflows and outflows? Yeah, what we are saying here is that increase in current assets like inventory means you are buying more inventories. Okay, when your inventory goes up, it means you are buying more because the only way your inventory will go up is you are buying more. Does it make sense? So increase in inventory means you're losing money. You're losing money. So if inventory is increasing, it's an outflow. But then when your inventory is reducing, what does that mean? It means you are selling more of them, so money is coming into the business. Then trade receivables is the same thing. Your debtors, if people who owe you, it's the figure is going up, it means they are not paying you, so you are losing money. But then if the people who owe you, the figure is reducing, that means they are paying you, so it's an inflow. Now, the reverse of that is true. So what is the reverse? The reverse is that if payables, the people you owe, their figure is going up, it means you're not paying them. So you're actually using their money to run your business. And if you understand finance a little bit, one of the short-term sources of finance to an organization is trade payables. It's buying on credit. So if the trade payable figure is going up, it means you are saving money, you are not losing money, you are not taking any money out, the money is still within the company. But if your trade payable figure is reducing, that means you are paying your suppliers. That means you are paying the people who owe you. So money is going out of their business. Are you okay with that? And it cuts across for current assets and current liabilities as well, because trade payable is current liability. So other current liabilities like expenses, owings, uh, you know, provisions, though they have the same behavior coming in the particular case. So Joe Thomas, let me know if that is clear for you in that case. Mohammed Umar said, we can also credit accumulated depreciation. I don't know the context in which that statement is coming in from, though. Lamin Hassan said, Sir, I want you to go over government grants. I think I have already done that. Let me know, Lamin, if the explanation I gave earlier, because I think your question came with Samuel Sapon's question, and I explained that again. Let me know if you are okay with that, Lamin. If you are not, then maybe I would have to just go through it again. Mohammed said, Lamin, I can help you to understand government grants very easily. Okay. Israel said, Inshira, what about decrease in investments? Okay, what kind of investments? Investments decreasing means we are selling the financial instruments. So that is an investing activity. Okay, Israel. So those items will come under your investing activity. Sounds good? We're going to be bringing it under investing activity because anything that has to do with investment, acquisition of assets, we will get into that later on. I'm just expanding a little bit on the operating activities. We'll just bring it under investing. So if there is decrease in investment, it goes into investing activities. And when your investment is decreasing, it's an inflow because it means money is coming into the business. Money is coming into the business. Israel, let me know if that is okay for you. Samuel said, I'm okay, Inshira, thanks. All right. Um, Dearest said, am I late? It depends on where you are at. You can watch the playback after it. Joe Thomas said, it's very clear, thank you. All right. David Boama Odro said, thank you for this, Inshira. Very deep. All right, that's exciting to hear. Mohammed said, I said that instead of crediting PPE, we can also credit accumulated depreciation. Oh, okay, okay, okay. Then Bones said, You're you're making accounting a sweet science. Thanks, sir. Always a pleasure. Accounting is interesting, when you understand it. Okay, so can we continue with the indirect method thing? So we deal with the movement in working capital, current assets, current liabilities, and then that's it. Okay, Israel said, I'm okay. All right. Current assets, current liabilities, then boom, you're okay with that. So after that, we now get our cash generated from operation activities before we bring in income tax. Now, remember, we've already looked at this is the interest paid during the year. So that is going to be coming here. It's like, let me duplicate this format I have here, maybe to the next slide so that I can add what I want to add. It's like I squeezed the thing here, but let me just duplicate it and take it to the next page. Give me a moment. Oh, come on, man. There we go. So I'm just going to copy it and take it to the next slide because I want to add some things that, yep, this is better. So I'm going to just clean this guy up. Okay. Because we're going to bring in the interest paid. And you may do workings for that. Now, remember, like I said, if assuming in the statement of financial position, you don't have owings for interest, right? Then you are okay. No cause for alarm. There is no need for you to do anything. The figure that you deducted as the interest charge, okay, will be the same, will be the same brought here. Hey, please let me take that again. The interest charges and expenses. So it's supposed to be added back here. This is a positive. Please correct that in your pro forma if you are writing. Because the interest charges and expenses, we are adding it back, okay, when we try to do the workings up. So the interest paid, if it happens that there is no interest owings in the statement of financial position, then we will go with the same figure we added above and come and deduct it at the bottom. Now, someone will say, okay, if that is the case, then don't bring it at all. No, you have to bring it because you get a tick for that. And it also gives us the rationale for the presentation as well. Then the next thing is going to be income tax, paid because the company pays tax. And you may have to do workings for that. Okay, so in the cash flow, we may have to do workings for income tax. So that is another workings that we do, income tax. Let me switch this guy to this place a little bit. And then let's bring income tax up. Now, some of you are not comfortable with the T accounts. Whatever you're comfortable with, you stay with it, all right? But the OGs are the OGs. T account is the OG. But Whatever you're comfortable with, you go. Tax is a liability, so you're going to bring in the balance brought forward. But be careful here, you're going to bring both the current tax and deferred tax situation. So in the question, if we have current tax, you bring it there. These are the opening balance. If you have deferred tax, you bring it there. Then you're going to bring in the closing figure. So you pretend to close the account. Then you bring in the closing figure here. Balance carry down. Current tax. Deferred tax. Please note that the opening balance can be on the debit side. Okay? Just take note of that. The opening balance can be on the debit side. So just take note of that. For instance, if the company has a deferred tax asset, then it will be on the debit side. If they have a deferred tax asset, it will be on the debit side. If they have a deferred tax asset, it will be on the debit side. So sometimes you are doing income tax accounts though, but then the opening balance may be on the debit side because there is a deferred tax. So please be careful there. Be careful there. Then we'll come to the charge for the year. You got to be careful because charge for the year will be coming from both your profit or loss accounts as well as the OCI. Please be mindful of that. If you remember last week in our discussion when we were doing income tax and IAS 16, you saw that there were deferred taxes that were charged in the OCI. The same thing happens to the cash flow statement. If you are preparing the cash flow statement and you're looking for the tax that was paid actually during the year, you go to the current year P&L and OCI, and if there is tax in the P&L, bring it up. If there is tax in the OCI, bring it up. So the charge for the year here is from both the P&L and OCI. Let me also say this clearly, that there are some times when your income tax charge for the year will rather be on the debit side, meaning even though the income tax is supposed to be negative, it is rather a positive figure. The reason why that could happen is that the entity has a lot of deferred tax assets. So if during the year the entity has a lot of deferred tax assets, then it will reduce their tax liability. So they will rather have a positive income tax figure in the P&L account. So please take note of that very well. It is not always that your income tax figure will be negated. Sometimes the income tax figure in the P&L accounts will be positive. If it is positive, it means the entity had a lot of deferred tax assets, and so it reduced the tax charge for the current year. For that reason, the charge for the year will instead be on the debit side. I hope you're getting the treatment here. So you have to understand that. But this is default, what we expect. But you don't always have to go with a default. It's an accounting thing. So the balancing figure will always be here, and that will be the tax paid for the year. That'll be the tax paid for the year. So that is what you are taking to the operating activities as the tax paid for the year. Any questions for me? Now, there are other things that may come in as part of the adjustment. That the key things are the current asset movements, current liability movements, income tax, interest, depreciation. You would have to look at those things. You would have to look at those things in that particular case. All right. So when we finish, this will give us the net cash flow from operating activities. Net cash flow from operating activities. So that is using the indirect method to prepare your cash flow. Now, so if the examiner tells you, oh, prepare the cash flow statement using the indirect method, the indirect method is just about the operating activities. That's all. And always it is the method 2 that we will be excited about. That is the indirect method. Like I said, that is the default way that will prepare the cash flow. Nonetheless, the direct method must also be known. The direct method must also be known. Any questions, please? See some questions coming up here. Let's see if I can take them. as we go. And then let me know if there are any questions you have for me. Mohammed said, is this indirect method of cash flow statement? Okay, I think, yes, I've already answered that. Perifa said, please, what about the firm receive grants in the form of an asset? That is not cash, so it doesn't come in the cash flow statement. So if they receive an asset, that will come in the PPE account, which I'm going to show you in a moment. So it will be adjusted for in your main PPE account, but it is not something that will come in the cash flow statement because it is not cash. And anything that is not cash is not brought in the cash flow statement. There are two methods of recording asset as a grant. I don't understand that. Number one, we can record at fair value. We can record at normal. Okay, I don't understand those statements coming in from there. Any questions for me, please? Any questions? Okay, I'm seeing a chat coming in also here. Let's see. Ebane Owusu said, can you go over the interest charge and interest paid again? Okay, so this is what we are saying, that the interest charge is in the current year P&L account. Okay, the interest charge is in the current year P&L account. So that was deducted. So what we do is that we come and add it back. Then if in the statement of financial position you have interest owings under current liability, so in the face of the statement of financial position you have interest owings under current liabilities, then that means the interest charge for the year was not what was paid. So you then have to come and prepare interest expense accounts so that you can determine the interest that was paid actually during the year. It is in the interest expense account that you will bring the opening balance of the interest owings under current liabilities, which is previous year figure, the closing balance, which is the current year figure. Then you go to the P&L account, the charge for the year, which you added back whilst you were doing the adjustments on the credit side. Then when you balance, the balancing figure becomes the interest paid for the year. The balancing figure becomes the interest paid for the year. So that is the difference between the interest. But like I was saying, if we don't have anything on the face of the statement of financial position under current liability relating to interest owings, then the interest charge for the year will be the interest that has been paid. So the same figure you added above under the adjustment will be the same figure you will come in less below as interest paid. Are you okay with that? Eben Owusu, let me know if that is clear for you. How can I assess the questions of cash flow? Which questions? Because I have not introduced any questions yet, but whatever be the case, any questions we'll be solving will actually be coming from my book in that particular case, or our question kits in that regard. Another question comes up here. What do we have? David Boama Odro said, let's give thumbs up for this wonderful presentation. God bless you, Nhyira. Thank you. God bless you too. So let me bring up the PPE situation, which is another workings you have to do in a cash flow. So in cash flow, these are fundamental workings. Now, there is something I didn't bring. Let me even bring it here. Dividend paid. You see, there are two ways dividend paid can be treated. Stay with me carefully on this one. Probably this is the last part. Dividend paid can be brought into the operating activity or investing activity. It depends. You decide. It's in your court. You are the boss. Whatever you want, go for it. Does that make sense? So let's say, for instance, I want to bring it here. If I want to bring dividend paid here, then I need to do workings for it. So dividend paid, I may have to do, sometimes you don't have to do workings, you know, the examiner will give it to you generally. So net cash flow from operating activities. So dividend paid can be brought here or can be treated in the financing activities. Like I said, you are the boss, you call the shot, you determine wherever the heck you want to put it at. Are you getting it? So let's see. That is the third workings we can do, dividend paid. Now, how do you get dividend paid? You have to use retained earnings. So you have to open retained earnings account, and the retained earnings account will help you to get dividend paid because dividend is paid from the retained earnings. So you want to calculate dividend paid from retained earnings, slashing the currency signs. Now, retained earnings keeps a credit balance. So we're going to be bringing in the opening balance brought forward here. Then you close the accounts to bring in the closing balance carry down. Then the profit for the year will be brought here. Please, not total comprehensive income, just profit for the year. Not total comprehensive income, just profit for the year. So you close up this account. The balancing figure will be dividend paid. Okay. The balancing figure will be dividend paid. The balancing figure will be dividend paid. So this is how we calculate the dividend paid if it is not given to us in the question. Sometimes the examiner will give it to you, so you don't have to do anything about it. But if it is not given, then we certainly have to calculate it. So that is, like I said, the dividend paid can be in the operating activity or the financing activity. You are the boss, you call it wherever you want to put it at, you're going to be good. The most important thing is knowing how to arrive at the dividend paid if it is not given, especially, and also knowing that it could be in the operating or financing, not the two. Just bring it at one point, and that will be all in that case. Any questions, please? Lamin said, "Sir, I want to know which time this lecture is commenced. Like, I like the lecturing. We do our live stream 4:30 p.m. and you can subscribe to the channel, click the bell notification icon, or follow me on Instagram because the details will be posted there. In that case, I want to test myself. That's how much good I understand cash flow. That is why I'm asking for questions. Or you can get questions. I don't know what you are studying. You can get questions, some ACCA questions online, or you can, go to the ICAG website. Some past questions are there that may involve cash flow. However, people who enroll in our full courses get access to our question kit, and our question kit has a number of questions relating to cash flow, and we have supplementary question kits that are also given to students who enroll in our full course and study directly under my mentorship. So you can check online. You will get some questions on cash flow to try your hands on, or the ICAG website. Go through some of the past questions. You should get some questions in there in that case. Or like I said, our question kit is available to students who enroll in our full course to study directly under my mentorship, and they get access to the material and they're able to, practice a couple of questions in that case. Bernard Pinstel said, Mohammed, we all know, so allow us to listen in peace. Okay. So that is the idea about the dividend. The dividend. G. Clark said dividend paid will be deducted, right? Yes. As you can see, we put it in brackets. As you can see, it's in brackets here because it's an outflow. It's an outflow. So we put it in brackets. It's an outflow. So we put it in brackets. So that is the idea about investing, sorry, cash flow from operating activities. All right. So three things we need to know about: operating activities, investing activity, financing activities. So far, under the operating activities, we said there are two methods we can go in for. Direct method, where we are dealing with payment to employees, payment to suppliers, interest paid, tax paid, receipt from customers. Those things will be brought in. But the indirect method is the default approach. That is where we go in for a lot, and that is where we're going to be dealing with the profit before tax. And so far, we have come up with three workings that we need to look out for. The fourth working will be property, plant, and equipment, PPE, property, plant, and equipment. How we prepare the property, plants, and equipment. Because sometimes depreciation will not be given. The depreciation for the year will not be given. Okay, the depreciation figure that we are seeing here, sometimes it may not be given. So you need to calculate it yourself. How do you do that? The PPA account can give you a clue on how you actually compute that. But I'm going to be concluding around here today. And God willing, Wednesday at 4:30 p.m., I'm going to be coming your way with a part two of this cash flow discussion. And then we'll finish with the investing and financing. Then we'll pick a question to see how we can actually work ourselves out on the cash flow. But this is the main takeaway I want you to have. If you don't understand the accounting standards, you'll get zero on cash flow, because you realize that everything we're discussing here, it's an accounting standard. Depreciation, IAS 16, IAS 40, impairment, IAS 36, amortization, IAS 38, grants, IAS 20. Okay, income tax, IAS 12, interest, we are dealing with financial instrument situations coming in there. So your understanding of the accounting standards play a key role for you to be able to actually prepare the financial statements. But if you don't spend time to really understand the standards very well and know how they are supposed to be treated in the P&L accounts and recognizing the statement of financial position, then you're going to screw it up when it comes to the cash flow statement. So it goes back to understanding the accounting standards. Once you understand the accounting standards, you'll be in a better position to actually pass the examination. So that is what you need to understand. I'm going to conclude around here today. God willing, Wednesday, same time, 4:30 p.m. I'm going to be coming your way with a part two of the discussion for this. Then we will continue, take some questions, and see how we can prepare the cash flow statement. Any questions for me quickly? We have a public sector class today in the next few minutes. And so I need to wrap up my class here and then get excited about that class as well in the next few minutes. Any other questions for me before I jump over? I don't know what that is there. Okay, so that's it about that. Thank you guys for joining us on the stream. Nicholas Swawini, Amina Sam, Som Israel on Facebook for the thumbs up. Thank you very much. I really appreciate that. Ring said greetings from South Sudan. Greetings from Pakistan. All right, Mohammed, all the best. I'll catch you same time on Wednesday. Remember, you can follow me on Instagram because details will be posted there so that you can be part of the discussion and join me. So don't miss Wednesday because we're going to build up from this, and that is what will help you to be able to really understand the cash flow statement. Stay safe, have a great week, and I'll catch you on Wednesday. Bye bye.